Welcome back to 20 Minutes of Clarity.
I am Jason Noble, your host, and with me today is Andy the Man Merchant as we get into this topic now, which is how do you financially protect your family in three different phases of your life? When we look at financial planning, we break down three main phases of your life. You have your accumulation stage. Well, that's while you're working and saving money and accumulating. That makes sense. Now we get to the distribution phase. That's where you have money coming out of your portfolio to retire and live life and do life 2.0, do those fun things that you always wanted to do, right? And then the last stage, not so much fun, but just as important, is the transfer phase, when the money is being transferred to your children, to your next of kin, to your spouse next of kin, right? That's what that is. And if you don't have any children, it's going to beneficiaries of your choice or charities. You get the gist. Okay, you are no longer with us. But how do you protect your family and loved ones in those three different phases? Very important conversation, right? Because when we look at financial planning, you got to have that protection of your assets. What does that look like? So, Andy, if someone's in the accumulation phase, let's jump right into it, Andy.
Yep.
What are some of the things that we should be considering in the accumulation phase to protect our family?
Yeah, I just want to start off with it on there and just say, well, let's put our mindset into that phase of life. So this is speaking to everybody out there that is in that phase of life that you're building wealth, you're managing, you have more debt, so you're managing that debt, you're probably raising a family, focused on your career. And so the biggest impact to protecting your loved ones is by your income stopping, right? And so what we really need to do in this focus of life when we talk to our clients is we focus on the why you need this. Well, we just highlighted a few of those. You really need this because if you're raising children, the bills still come in, the expenses still need to be had, the debt's still out there, even if you're not out actively earning money anymore from due to an unexpected passing. And so this is really about family stability. And so normally, right, Jason, when we talk to our clients, there's really two types of insurance that can fall into this category that we talk to clients about. Most people have some kind of term coverage. That's just the easiest, lowest cost way to get the maximum benefit. It's usually very inexpensive. You can get this on your own, through your own policy, your own carrier, or you can usually acquire this through your work or group plan. For those that might be a little bit more on the accumulation phase, but having a little bit more discretionary income, this is when we start to incorporate those that possibly are looking at maybe more of a permanent life insurance policy. We're not going to go into the details of this, but it's a way to build future cash value to also secure retirement. So the nut of this one and the basis of this one is really about focus on why you need the replacement, and then go out and we work with clients on solving that replacement debt and in an event of an unexpected death. So that's really why I think this is a very important discussion point. We talk about it on a regular basis. So Jason, what kind of ideas or how do you go about helping evaluate how much insurance someone needs? Is it 100% of their debt and income, or is there some ratios that you're using?
Yeah, well, I mean, the main ones are really going into what is the human life value. That's one aspect that we evaluate. Another one will then be through the debt management. Like maybe if we're just trying to insure the mortgage, we do a decreasing term policy because you don't have to pay as much in the mortgage as you're paying into the mortgage as time goes on. Keeps it cheap, right? But then it's also looking at what is their overall financial picture looking at? Are they married? Are they single? Do they have any children? Right? How much are they making through work versus their spouse? What does that look like? Does their spouse work or not? Like all those different things come into play. And then like for our clients that their spouses, let's say one of them doesn't work, they still need some sort of policy because God forbid something happens to them and you have young children, you're going to have to get some sort of care as you continue to work to then provide for the family, right? So making sure that's addressed. But I look at this beyond just life insurance, right? Like through work, a lot of listeners will get disability insurance through their work. But what most people don't understand is who's paying the premiums. like if you're paying the premium before tax, if you were to get the disability and you needed to get that benefit, that's going to be subject to tax, right? So that needs to be factored in. If you're paying that benefit through your payroll after tax, well, then when you get the benefit, it'll be tax free. So that's something to consider. But a lot of the times, it will cover 50 or 75% of the income. Well, if you need a higher income replacement, well, then you go out and get personal insurance. Now, the interesting thing about personal insurance is when you change jobs, it stays with you, right? Versus if you leave a job, you're going to have to get the new policy at the new company, even if they offer that or not. So I'm also looking at what is the income replacement that's needed if I'm still here, but I'm not able to work, right? And I want to have you do the same thing. Everyone that's in the accumulation stage, meaning you're working, right? And you're not financially independent yet, where you can self-insure this risk. Maybe you can. Maybe you have a pile of money that if you stopped working, you could continue to retire. Maybe. But if you're not in that boat, you got to look not only at life insurance to protect the loved ones that if you're no longer with us, but disability if you're with us but incapacitated where you couldn't work and do the same job that you were doing. That's a whole other conversation that takes more analysis, but that's the things that I think about when it comes to this phase of life, which is the accumulation. Let's transition now to the distribution phase. Now, I like what you did, Andy. Can you get us back in that mindset of distribution? Like what's going on in their life, generally speaking, that now they're ready for the money on this phase of life?
Yeah, and I think this is another one that we talk a lot about, and we're gonna highlight a few points, but most of the time, right, just when we talk to some of our clients, they're like, I'm retired now, I don't have income, my debt's paid off, why do I need life insurance, right? And I often tell people, life insurance is just leveraging somebody else's money for a smaller amount of premium, right? And the reality is that you don't know if you're going to need insurance or not, or some kind of large payment. So even if you're in retirement, maybe you're someone out there who has. Let me back up real quick here. You got to think about your income sources when you're in retirement now, and do any of those income sources go away if you were to pass away, right? So it's the go away if you pass away test, and things like Social Security. It goes away. Now, there's some benefits that your spouse will maybe step up and get a different amount of income. But the reality is that half of your benefit is going to go away, or one of the spouses. Pensions normally have some kind of payout option that is usually life dependent. If the primary earning spouse's income goes away, or pension passes away, that pension will go away. So you got to start by saying, okay, what income sources go away in the event this happens? The second thing is that you may have other debts. So it's still important to carry a form of life insurance even into retirement. And I think the biggest thing that people most commonly miss are those what I mentioned is pension and pension benefits and Social Security benefits being reduced or going away. And by having that peace of mind and that security, because that's really what you want to know, is that your income doesn't change in the event someone passes away while you're in retirement at whatever time frame.
Another key aspect of this, and I'm really liking the mindset that we're having in this conversation, Andy. I'll pause to say that. So what about like long-term care, right?
Yep.
We talked about if someone passes away, there's still a need for life insurance in that scenario to replenish. Now, you can self-insure that risk if you have piles of money and right, or the age gap between the spouses, that comes into play as well. Like how long will that look like, and who's older, the husband or the wife, and this. I mean, all that comes into play when it comes to actuarial tables and financial planning and things of that nature, right?
Yep.
But let's now go into you're with us, but you can't do 2 of the 6 ADLs. You can't button your shirt, and you can't transfer yourself from the bathroom, from the toilet back into, you can't transfer yourself. You can't take care of yourself, right? Like, you need help. Long-term care needs. I mean, it's a high percentage of individuals who are going to experience where they can't perform 2 of the 6 ADLs. A lot of studies have been on it. Last thing I looked was like around 74%, right? But the numbers change. The percentages change. of like how many people would actually have this situation arise. So I look at, can you self-insure that risk? Can you do it yourself from your portfolio? And will you go get the help you need, knowing that you got to spend $8,000 a month to get the help you need and want? Will you do that? Not only can you do it, will you do it, right? Mm-hmm. Or would you get a policy that covers, let's say, $5,000 a month or $7,000 a month? Maybe not the Cadillac plan that covers $15,000 a month, right? Because the premiums will be just out of the control. But you get something that's going to cover a decent portion of the cost of care, so that the way that it works mentally that I've seen from my own clients is when they have those situations arise and they need additional care, they're like, I paid into this policy, I'm going to get my money back. I'm going to tap in, and they'll go get the proper care. Also, they're extremely happy they had it because they don't have to withdraw as much from the portfolio to get that proper care. Now, I do like those policies where they just get the money and they can do whatever they want with it. They don't have to show receipts like a reimbursement policy. But it's so important that you work with an advisor that knows how to construct the long-term care policy that's in your benefit. It's in your best interest. There's ways that advisors have constructed these policies, Andy, that I'm going, there is no reason why they did this other than to line their pockets with additional money, right? So it's super important for every listener out there is to make sure that you're working with an advisor that will educate you along the way into how the policy is being designed, the why for that, to make sure you truly understand the different facets of long-term care. But when I think of life insurance, I'm thinking maybe an ILIT could play in to offset estate taxes and things of that nature. A lot of things will be step up into basis, so I got to make sure I'm looking at that. The other thing that I'm considering, Andy, before we get to the next topic, is do they have a lot of money in their pre-tax and like their rollover IRA or for? I know that with the 10-year rule, with that money going to the children, they got to withdraw all that money within 10 years, driving up their taxes, their ordinary income taxes. Maybe an insurance policy that goes to the children now, have some offset that risk, is a consideration as well. So there's many different facets to having protection in the distribution phase. And I know that what I said leaked in right into the transfer phase. I just Andy, I can't help myself, right? It just shows like when you're doing comprehensive planning, you're not looking at just each stage in a silo. They're all connected. The guidance I'm giving someone in the accumulation stage could be for the distribution or even transfer stage. The conversations that I'm having with my clients near or in retirement, it's not about just, can you retire, right, and do the things you want to do? Can we address unexpected expenses that happen throughout life? You know, Andy, I'm going to get on a quick soapbox. I have this couple, they go, I need $75,000 a year to live my life and do the things I want to do. We do this program called Portfolio Payday. Money comes in to an account. We send out money to them twice a month, and anything in excess goes for long-term investing over time. Well, it allows me to see their spending drift. Last year, they spent $132,000. So we did the meeting, and I'm like, what are you spending your money on? What's going on? They had healthcare things come up. They were taking care of a family member, right? All rational, reasonable things. They weren't just going high on a hog and and just going on the exorbitant trips. That's a far cry from 75 to 130. And I said, here's the deal. I want you guys to learn this. You're about 10 years away from retirement. So you got time to learn this lesson. When you're retired, those things could still pop up. Maybe it's not taking care of your mom anymore, but maybe it's taking care of one of you. Or maybe instead of it being one of you, you got to replace your car, or you got to replace the roof. You got to replace the air conditioning or the heater. Those things cost money. And in our prior podcast, you talked about how your son talks about the cost of inflation, right? What does that look like over the course of a retirement plan? Right? So we got to build all these things together. But let's get to the transfer phase, Andy, because I think this is ignored by a lot of advisors. They don't want to talk about their clients dying.
Yep.
It's not a fun conversation for anybody. I could tell you, because Andy and I have to do this. It's part of the job. But what's an important thing in protecting family when it comes to the transfer phase of life?
Well, I mean, and kind of piggybacking on what you were just saying to now, insurance and just in general just needs to be thought about differently. This is about a recapture. If you're in retirement and you have those like higher spending moments that might arise, but you still have a legacy goal that you want to leave money or assets to your family. One way to be able to do that is to be able to spend more during those peak spending moments, knowing that you have an insurance policy or a recapture benefit that's going to be able to provide that benefit, right? So that's number one. But then when you start to move into the legacy phase of life, now you're starting to ask yourself, okay, do I have an estate tax? Are my children going to have to burden my any kind of taxes due to the asset type that I own? Do we have an illiquid asset? Maybe your net worth is of a certain dollar amount and most of it's owned by farmland, which doesn't have a lot of, maybe it's not going to produce as much cash to pay the tax. I don't know if Jason, if you've been watching Yellowstone, I was going to write this down for this topic, but they're talking about not giving away because Yellowstone's been out long enough. But there's an episode where Kevin Costner, in whatever his character is, I forget now, passes away, and they're trying to raise money in order to save the ranch, the ground. And they're talking about the fact that by selling all this and raising all this money isn't going to do anything but just incur more debt tomorrow. They're fighting to save the land because they didn't have enough coverage to take care of the asset. So when you're thinking about transfer and legacy, maybe it's not just about having money to your kids or to your family. That's, some people say, I just want to bounce my last check. That's fine. But what about those legacy assets that you want to protect? Is it family? Is it a car? Is it an heirloom? Is it something that could have some value that we need to be maintained? So we really encourage our clients to think about it from that perspective, not just I'm leaving my family money, right? That's the hard thing that a lot of our clients have to deal with and to kind of swallow during this conversation. So that's when we're looking at more permanent policies. That's when we're, talking about, optimizing and enforce current policies. There may be some old policies that just need to be reviewed, right? Maybe you have a whole life policy that would make more sense, or maybe you need to do a paid up. I'm getting a little into some strategy there, but the point of it is this phase of life, you need to review it because you're probably at a phase of life you can't go get new insurance very easily or very cost effectively. And so you're going to have to get really kind of creative on your assets. And we've hoped that you've already had this conversation before you get to this, or as Jason's point, and then I'll get your thought, plan for the legacy transition earlier in life allows you to have more control and flexibility on the strategies you use. So even if you're like, I'm not going to have this massive estate tax liability because the estate tax limits are so high. If you're 40 years old, you don't know what those limits are going to be in 50 years. So you might as well plan as if there is going to be an event and get those baselines in place first. So that's really how we kind of talk about the transition story.
And I would be remiss with my clients who are attorneys that we don't at least touch on estate planning throughout all three phases. We touched on this heavily in a prior podcast, but do you have a will? Do you have a trust? Do you have a durable power of attorney? Do you have a medical directive, right? These are all important in all phases that we just discussed. And it goes back to course correction and adjustment. Maybe you start off with a will when you're early on in the accumulation phase. You assign guardians to your children in the event that you and your spouse, you both pass away. What does that look like, right? But then it moves into like a trust-based plan as your assets continue to grow and you acquire more, right? And your accumulation phase is becoming more mature, right? Okay, well then maybe you start then looking at more advanced estate planning techniques, different types of trusts, for that transfer plan that you have in place, for the estate tax mitigation, from charitable giving, things of that nature. There's so many different facets to this. What does that look like? But this is the beautiful thing is you could design your estate plan. You could design your assets in a way to fit your vision and then course correct and adjust as time goes on. As we wrap up, Andy, any last words for our listeners?
Just take action. Don't look at insurance as a product. That's my biggest call to action right now. If you have an insurance policy, you need to review it. I know you're going to bring us home on some call to action items, but don't just take insurance for the word that it is and the sales that it was. Take it for how it can fit into your overall plan.
That was 20 minutes of clarity. You just listened to Andy, the man merchant. He's the man because he told you to take action. Take action from this podcast. I'm Jason Noble. I'm just sitting here dropping knowledge. Expect us to come back next week with another podcast on our weekly podcast. Tune in, like, subscribe, and follow, or share this with someone that you feel needs to hear this message. Thank you so much and have a great day.